All right, sound the recession alarms. Woo, woo, woo. The money supply is shrinking by the fastest pace since the Great Depression. And I know your next question already. Who gives a shit? Me. I do. And you should too. Because we want to have a good idea of what is about to happen in the markets so we can properly invest. And a shrinking money supply is a large recession indicator accompanied by many other signs. Before I dive deeper, make sure you subscribe so I can share this important stuff with you. I will make you rich and famous and beautiful. No, definitely not the last one for some of you. Just kidding. Just subscribe. So, here's an article by Reuters talking about the shrinking money supply. Now, we can see they state US money supply is falling at its fastest rate since the 1930s, a red flag for the economy and financial markets. By the way, this next part may be a little technical for some people, but I'm going to break it down and make it simple for you. So they continue. Money supply has now been shrinking year on year since December, an unprecedented development in modern times that should make investors sit up and take notice. Growth, asset prices, and inflation could all weaken. It is largely a consequence of the reversal of the liquidity generated by massive post-pandemic fiscal and monetary stimulus. The Federal Reserve shrinking its balance sheet via quantitative tightening, failing bank deposits, and weak demand for the provision of credit. All right, so let me break down all of what they just said down into much simpler terms. So, what does it mean when they say the money supply is shrinking? Well, it means that there is fewer dollars in existence than there was before. And this, of course, includes things like cash, bank deposits, and other forms of liquid assets. A lot of people get this concept confused. Now, when the average person thinks of the money supply shrinking, I think they get this picture of their head, or in their head, of something along the lines of like the government burning a bunch of cash. It's barbecue time! We're gonna roast some marshmallows to a bunch of $100 bills. Woohoo! Super fun. But this is not what happens. You have to understand that our money today is not really money. Our economy today is built off debt. That means that manipulation is fairly easy since the central banks can make moves that really highly influence what happens with things like the money supply. If we used real money today, like precious metals, what they are doing wouldn't be possible. And of course, that's part of the reason the Fed was created and why we left the gold standard in 1971 was so they could have more control of our economy. But totally different story for a different day. But now that you know that our economy is built off of debt, you should know that our money really isn't money at all. And let's talk about how this fake money is created, and that will help you understand the bigger picture. The main way that money is created is through fractional reserve banking. And fractional reserve banking, or lending, is a practice where banks can lend out a certain amount of money based on what you deposit. For a long time, the banks had a 10% fractional reserve requirement. That means if you deposit $1,000 into the bank only had to keep 10% in reserves, or $100. The other $900 they could lend out, which is essentially the creation of another $900. But what happens when that $900 is lent out and that person puts $900 in the bank? Well, the bank has to keep $90 in reserves, but they can lend out the other $810 and another $810 created out of nowhere. Basically, fractional reserve banking or lending is a way for the banks to create money out of thin air, or to be more accurate, create money out of debt, which I have to say is even more impressive than creating money out of thin air. They are creating money out of debt. Impressive. Let that sink in. And since March 26, 2020, the reserve ratio has been zero. Yes, 0%. That means if you put $1,000 into the bank can lend out the full $1,000. So imagine this. So if everyone went to the bank and said, I want to take out all my money right now, do you understand what would happen? Complete chaos. The reason for this is because that money is not actually there because of the system I just described. Those numbers in your bank account are just numbers in a computer, not the amount of dollar bills actually sitting in a vault somewhere. The banks are just betting on the fact that not enough people will want their money out of the bank at the same time. Because once there is a bank run where a bunch of people want their money and the bank doesn't have it, this leads to bank failures. So if everyone ran to the bank at the same time, right, it would basically cause a worldwide collapse. like a bank failure on steroids. But let's dive deeper, right? And let's talk about how the money supply can shrink now that you understand our money, quote unquote, that we have today. So the first way the money supply can shrink is through central banks selling government securities. When a central bank sells government bonds or securities in the open market, financial institutions and individuals purchase these securities with cash. This cash, which was previously in circulation within the economy, is transferred to the central bank. Effectively, this removes it from the economy's money supply. As money is exchanged for bonds, there's less currency available for lending and spending, leading to a contraction in the money supply. The second way is when the central banks raise interest rates. We've been seeing this lately. Higher interest rates make borrowing more expensive and saving more attractive. As loans become costlier, both consumers and businesses are less inclined to take out new loans. This leads to a decrease in the amount of new money entering the economy through bank lending, which of course results in contraction of the money supply as well. Another way the money supply could shrink is if there is a decrease in bank lending because of risk aversion. Now, if banks tighten their lending standards, fewer loans are issued. And remember, I just described fractional reserve banking. Since you know that system now, loans effectively create new money, so a decrease in lending translates to a decrease in the money supply. Also, loan repayments exceeding new loans is another one. If more loans are being repaid than new loans being issued, the overall amount of money in the economy decreases. When a loan is repaid, the principal amount of the loan effectively disappears from the money supply, and if not replaced by new loans, this leads to a contraction. And the last one I'll mention is the withdrawal of currency from banks and bank failures, which we talked about a little bit. If people lose confidence in banks and withdraw their deposits in cash, keeping it out of the banking system, this reduces the amount banks have available to lend through fractional reserve lending, right? And if banks fail and cannot return deposits to their customers, this directly reduces the money supply. So these are some of the major ways that a shrinking money supply happens. Okay, but why is this concerning? Well, let's take a look at this chart. We can see that historically, these contractions have not fared well. There was the Panic of 1837, followed by a lengthy depression. The Panic of 1857 led to a depression. The 1865 to 67 recession. The 1873 to 79 depression. The 1893 and 94 recession. The 1913 and 1914 recession. The 1920 to 21 recession. Of course, you got the infamous Great Depression in the 30s. And the 1948 to 49 recession. All of which came with contractions. And here we are again in 2022 and 2023 with another contraction. And there's so many other recession or even depression signs going on right now. You got things like the rate of which people are dipping into the retirement assets, record levels, the record levels of credit card debt, and of course you got the yield curve inversion, which is probably one of the most popular ones, among many others. I believe we are getting some very big signs that a big hit is coming. Personally, it's why I moved a portion of my 401k over to my precious metals IRA to protect myself. Why sit around and get clobbered when you don't have to? If interested in learning more about that, the company I personally use is in the description below. Get their free kit and educate yourself more at the very least. Or at least find another company that suits you if you don't like the company I use. But be very careful of leaving all your money in a traditional 401k right now. I think they are going to get hammered hard again. Protect yourself and make sure you subscribe so that Tim and I can help keep you up to date.